In this week's update, the importance of relative strength and how it has powered results this year and every year, and gold stocks revisited. My name is Garry Davis, and as always, this is general advice only. And remember to subscribe and like the video. All right, let's start with an overall perspective on the market. As I've been saying many times over the last few years, it's pretty obvious now that we're in a secular bull market that started in 2013. And therefore, if you look at the typical length of a bull market, we could have another decade to go. Who knows? That's not a prediction. That's just an observation of what history tells us. Now, within that secular bull market, we've already had a couple of very sharp pullbacks, and certainly the one in February, March this year constituted a cyclical bear market. Incredibly short, but nevertheless, that's what it qualified as. And I'm sure that we'll get some more before this secular bull market has run its course. But that still doesn't change the fact that, that is the environment that we're in. And in a secular bull market, resistance levels tend to break and support levels tend to hold. When you're in a bear market, the opposite occurs. And so surprises tend to be to the upside. Things tend to work out better than what logic would dictate. And we're certainly seeing that at the moment. A lot of people are scratching their heads about how the market can keep going up in the face of the virus and all of the consequences of that around the world. But the key message that I've been trying to get across to everybody for a long time is that against traditional, conventional thinking, you need to forget about trying to trade the market as a whole. Now, conventional wisdom says you go out and you get a lot of diversification, and that is how you actually manage risk. I just think that is a completely wrong approach to the market. The way that I go about it and have gone about it for a very long period of time is just to find the best fundamental and best technical stocks and just do that. Trading the market is just such a very limiting way to think about how to do it. It's just fitting in with what you've heard or read or what the bulk of opinion still holds as true. It doesn't work very well. The sheer fact is that strength begets more strength. And I'll show you some charts in a minute on relative strength that will really highlight that point very graphically. So we go out and we simply find the strongest stocks in the strongest sectors. So let's just have a look at that initially. So what I've done here, I've done it on America because the Australian indices are often very significantly impacted by just a couple of stocks. A couple of really big stocks dominate a particular index, whereas in America that's not the case. So I think you actually get a more meaningful answer. So what I've done here is I've put the S&P, which is the green line, fourth from the top. So we're looking over the last 12 months. And I've tracked against that in order from the top, XLK, which is the technology sector, and then XLY, which is consumer discretionary, and then XLV, which is healthcare, and then comes the S&P. So the three sectors that have outperformed the S&P, in other words, they've done better over the last 12 months, and particularly, as you can see, in the last 3 or 4 months since the crash, it's been quite spectacular, is technology, consumer discretionary, and healthcare. Now, lagging the S&P a little bit is consumer staples, XLP, then industrials, which covers a lot of different industry groups. But then look at the banks, XLF and XLE, the energy sector. So why would you want to have exposure to the banks and the energy sector when you can be in technology, consumer discretionary, or healthcare? Now, within each of those sectors, they break down into many industry groups, which in turn then have a substantial number of individual stocks. So why not just focus your attention on those three sectors and the industry groups within those sectors that are doing the best? Still gives you thousands and thousands of potential stocks. Why trade the market? It just doesn't make sense to me at all. So that's the the flag waved for the concept of relative strength. It is just such a powerful tool to use. And if you're not using it, then you're just not using one of the most important tools that is out there. Let's look at American stocks. S&P rose 1.8% on the week, but the Nasdaq is absolutely killing it. It was up 4.8%. And its relative strength, again, the Nasdaq is heavily influenced by technology and also by biotechnology. The second point that I'd make is that there is still huge sums of money on the sidelines in America. All the data shows that there is still skepticism, there is still a great deal of fear and nervousness. So there is still huge sums of money on the sidelines. And with sentiment where it is, these are not the conditions under which you tend to get a top in the market, but not a major top anyway. So the reality is that new economy stocks, so think technology stocks, are really flying, and the old economy stocks, the old industrial stocks, are not. So the message is starkly clear: to go with what is working and just forget about the rest. Now, we've got earnings season starting this week with the US banks, so that'll be really interesting to see how those numbers come out. There is significant expectations around technology and a lot of healthcare stocks that they're going to be able to deliver. And also, it's pretty obvious that a lot of the online retail stocks have just been doing enormously well. So I think we're going to see some tremendous results from the online retail. Now, the US dollar was lower by a little bit, down to 96.5, and the 10-year yield slipped a little bit further down to 0.65. I mean, just step back and think about that for a minute. Are you going to give your money to the US government for 10 years, and in return, they're going to give you 0.65 of 1% for 10 years, which is almost certainly below the level of real inflation, and so therefore you're going out backwards. Why anyone would think that that was a good investment idea is completely beyond me. Anyway, that's conventional thinking for you. Let's look at the S&P. So we're just oscillating above and below this high that was set in the middle of the crash, or at the early stages of the crash, which was early March. So we've gone above it, and now we're just flicking below and above and consolidating around this level at the index level. But again, just, don't focus on what the S&P is doing, because it really doesn't matter all that much. Just zero in on the strongest sectors. For the record, let's look at the Nasdaq, and you can just see the difference, how far the Nasdaq is above the February highs compared to the S&P. It's an extraordinary divergence. So why wouldn't you be wanting to be in stocks that are mostly in the Nasdaq? I mean, that's where the strength is. Now, I know a lot of this is because of the FANG stocks. There's no question about that. But there are a lot of stocks that I trade that are not the FANG stocks. They're not the majors. They're smaller stocks, well down the pecking order. And there are hundreds of them that have got price charts that look like this. So, you don't have to be in Amazon and Google and Netflix and those sort of stocks that you might think are outrageously expensive. But, don't dismiss the other opportunities that are there, because they're just simply amazing. US dollar. Overall, the US dollar is really in an uptrend. Now, we're in a big consolidation at the moment, but if you come off the lows from January of 2018, so we're looking back over the last several years, then the US dollar is really still trending up, probably in a consolidation, and the odds would favour for me that the US dollar perhaps getting stronger in the near term. Anyway, we'll see. Now, the Australian dollar is also just in this. It's returned to its trading range, as I said last week. If you take out the February-March crash as a bit of an aberration, and you can do this with an awful lot of charts, both in stocks and in currencies. It's like that period never happened, and we've just returned to where we were previously. Okay, Aussie stocks. The Aussie dollar was slightly higher, but it's really just tracking sideways. And the ASX 200 ended up down 2.2% on the week, and that was really off the back of the fact that the US market finished a shortened week before their holiday down. And as I said last week, by far the most productive stocks in the Australian market, there's just no question about this, are the small to mid-cap growth stocks in sectors that have got tailwinds. It's just so clear where the real performance is that it's pretty easy to really zero in on the sort of stocks that you should be looking at. So the question that I raise most weeks is, conventional thinking would have you severely limit your return. It would say that you should just focus on dividends. Why would you do that and also at the same time raise your risk? Because a lot of these stocks that have been the traditional dividend payers, the banks, etc., are cutting their dividends. And along with that dividend cut, quite often comes a loss in capital value as well. So why would you severely limit your return and raise your risk by being focused on dividend stocks only? It's just habit. It's just conventional thinking that is completely amiss with current day. If you want cash, then sell some shares every 6 months. Don't be driven by fully franked dividends or the perception that fully franked dividends are this wonderful thing. 20% per annum beats 5% per annum in my book every day of the week. And the people that want to point to Warren Buffett and say, how he's always said, well, it's time in the market, it's compounding returns, all those sort of things, then do a compound return calculation on 20% a year versus 5% a year, and do that for 10 or 20 years. And I think you'll get the point. So let's just quickly look at the Australian index. And it's really a very stark market that we've got here. This is the ASX 200. So we've managed to return about 2/3 of the way between the top of the crash and the bottom of the crash. So that's sort of the benchmark at the overall index level. Here's materials. Materials have done better. So that's the BHPs and the Rios and the Fortescues. There's small caps, slightly better than the overall market. Healthcare has done a lot better. It doesn't look quite as graphic here, but the size of this crash was nowhere near like the other sectors, and it's still holding above its 200-day moving average. But then we go to finance, is still lagging severely, and then we go to energy, of course, and it's the worst of the lot. All right, let's move on now to precious metals. Gold rose $24 and finished at 1,800, so it got up to about 1,816, I think, at the peak. So we've managed to break that really important $1,800 level and managed to hold on to it by the close of the week. And this is all happening during a traditionally weaker period for gold and gold stocks. So we're seeing enormous strength here in absolute terms, but we're seeing extraordinary strength in seasonal terms. Now that translates to the Australian dollar gold price of just a tick under $2,600. So no wonder the Australian gold stocks are doing well. Now the other point that I would make too is that the future speculators are not really buying this yet. And I made a bit of a technical slip bit of a slip of the tongue last week, and I said above 1,800 would bring in the buyers. I think I must have said sellers because a few people picked me up on it, so thanks for that. But yeah, of course, what I meant was above $1,800 is almost certainly going to lure the future speculators into the market, because at this point in time, the number of contracts in the gold futures market to the long side is still less than half the typical maximum. So the future speculators are not fully invested in this market yet, and so that means, and with the leverage that they use, which is 20 to 25 times, they still have an awful lot of firepower to bring to this market yet. Now, precious metal stocks, the multiplication factors have not kicked in yet. When we look at GDX, we'll see that it's looking pretty robust, but there's so many things that are yet to come. Gold is moving higher, as we'll see on the chart, and it's a very strong, steep uptrend. So you can only conclude that it's, until it says otherwise, that gold's likely to go even higher. that is going to propel earnings higher for gold stocks, and it does that at an exponential rate. It's not a linear relationship between a higher gold price and the earnings going up for gold stocks. Gold stocks amplify that move, particularly on the earnings line, and so we tend to get this amplification where if gold went up 10%, then gold stocks in general would tend to go up 30 to 40%. So we're not seeing any of that yet. So from my perspective, stocks are set to move much higher unless, and this can always happen, and we can even see a move down in gold but still be within the channel. But unless gold rolls over and therefore earnings drop, which looks exceedingly unlikely at this point in time, then gold stocks are set to move a lot higher yet. So let's take a look at the sector. So we'll start with silver first of all. So silver still hasn't really played any sort of catch up yet. So if we go back, this is the peak in silver, around about $50 that occurred at the peak of the precious metals boom in 2011, and since then it's been a pretty despondent picture. So we've started forming this extended base down here, which is around about $21. So we've been in this base now for quite some time. We're getting on to 6 years now. We had a crash in silver during the beg your pardon, during the February-March crash, and we've rebounded, as with so many things, we've rebounded back to where we were fairly quickly. There will be some resistance around $21, but as I said at the start, in bull markets, resistance levels tend to break and surprises tend to be to the upside. So silver is still looking pretty good, but still is lagging gold by some distance. So this is the ratio between the gold price and the silver price. The gold price is still nearly 100 times the silver price, whereas the long-term average is somewhere around 50, 60 times. So we've still got some mean reversion to go, and as gold moves up, it means that silver really has to do some serious catch-up. Let's look at gold first of all on a daily. So you can see it's been quite a good rise since we broke out in the latter half of June, but it's more graphic when we look at it on a weekly basis, and you can see that we did break out above that key 1800 level. You can see the steepness of the uptrending channel. There's no question about that. Now the width of that channel, if you like, is about, if we took this point here down to here, we're talking potentially over a realistic time frame, gold could drop 60, 70, $80 and still be within the channel. So, remember that. And that sort of fall in gold would certainly cause some selling panic in gold stocks. But at the moment, you've got to stand back and say the uptrend is extremely strong and therefore it's likely to continue. Now, if we also look at the ratio between GDX and gold, and I've been showing this over the last couple of months as well. So we've still got a lot of catch-up. So gold stocks are still significantly undervalued compared to normal against the gold price. So we've also got that factor. It's improving since the crash. There's no question about it. But there's still a long way to go. We've got to get up to around about 0.45 is closer to a long term, which means that gold stocks have got nearly a doubling to catch up to the normal rate relationship with the gold price. Let's look at GDX. So this is on a weekly chart, and you can see a huge base that started forming in 2013. We broke out in April, pulled back, retested the breakout, so technically just about perfect, and now we've headed off again. And since the crash lows, which was about $16.50 on GDX, we're now trading at $38.40. So we've more than doubled. We're up about 120, 125% off the March lows in gold stocks. So I hope that everybody that's been listening to this video has been able to take advantage of that strength, because I've been talking about this now for a long time, and there's been some tremendous opportunities. Now, just to reinforce the money that's really underpinning that very steep rise in the gold price, despite the fact that the future speculators aren't yet really committed to this market. And I showed this about a month ago, I think. So these are the actual holdings in GLD, which is the world's biggest ETF. It dominates about 40% of the ETF market for gold, and it's showing the level of holdings in millions of ounces in from the peak in September of 2016. So you can see when that busted, then there was a massive amount of selling of gold from that ETF, which really killed the share price or killed the gold price. And so we fell all the way to 20 million in the bottom in January of 2016. But since then, we've had investment money. So this is really representative of investment money. And we're now back up to as you can see, 24, then 28 in January this year, then a huge surge into June of to 37 million ounces. So that was at the end of June, or I think that might have been the third week of June when I did this. And now, just a few weeks later, we've added another 1.6 million ounces. So this is all investment money coming into gold. This is not the futures speculators. They're yet to come in with a lot of firepower. So there's every reason why the gold price will continue. And now we've got a technical breakout. Okay, it's only minor at this stage, but nevertheless, we have exceeded $1,800, and that does have a psychological impact. So the outlook for precious metals still looks really, really strong. Turning to other commodities, copper has really shot up to 2.86. There is some increased demand. It's pretty mild at this stage, but the futures market is doing a couple of things. It's looking at the battery and electric vehicle market, and it's foreseeing what future demand is going to be like. But there's also fears at the moment about the reality of reduced supply coming from South America. There's been mines that have been significantly cut back, including BHP and Rio, because of the virus. And so there's fears about reduced supply out of South America. There is looking forward in terms of the electric vehicle revolution, and the copper price has gone up quite sharply, as we'll see. Crude oil edged up about 30 cents, so not a lot of change there. There's the spot copper chart. We hit $2.10 during the crash, and now we're hunting back. In fact, we're at the highest point in 12 months, back at 286. So copper looking very robust. Nickel, which got up to $8 a pound when the Indonesians placed a ban on export. That was a bit of excess enthusiasm, which came out of the price in the latter half of last year. We then got another move down during the crash, of course, but now we've recovered to about $6 a pound. But probably still a pretty solid outlook for nickel as well. I think the best of times is still ahead for nickel. So to wrap it up, there is a process, and I talk about this constantly, particularly in Portfolio Analysts, but also in the Insiders Club. There's a process that delivers good outcomes, and it involves seeking only stocks that have got undeniable tailwinds. Why would you just build your diversification around that? There's still hundreds and hundreds of stocks in Australia and thousands of stocks in America that are in sectors that have got undeniable tailwinds. So why would you worry about the rest of the market? Use relative strength to advantage. Just find the strongest stocks in the strongest sectors, because they're probably going to keep going. There is then two technical setups that I talk about constantly, and it's really all I look for, that provide high probability outcomes. Now, yes, you get some losers, of course, but it's all about probability. So just zero in on the two technical setups that provide that high probability. I do this every single week in Portfolio Analyst. Do your homework thoroughly. and keep an open mind, most importantly. Be driven by what the price chart is telling you, not what logic would dictate or what your personal bias might dictate. Now, I expect the second half is going to be tricky for a number of reasons. We've got potential reimposition of lockdowns and the economic damage that will do. We've got the US election, which is the real wild card. So I expect the second half is going to be quite tricky, and we've had some enormous gains in the market. But within that, there is still going to be outperformers. There are going to be stocks that are going to do better, significantly better than the index. So just go and find those. And that's what I'm doing. Expect considerable volatility around options expiry. This Friday is options expiry, the third Friday of every month. And so many stocks have gone up so strongly in this last 3-week period that many of them are in the money. They're in the money call options. And the put to call ratio is at a relative low at the moment. So that means that people aren't buying put options. They're not buying insurance. They're out there chasing this market and they're buying call options. Now that in itself is not a bad thing, but around options expiry, market makers can do some very tricky things that can cause the share price to be quite volatile. So you might see that start to kick in Thursday, Friday this week, and certainly the week after is typically a little bit weaker. So just be a little bit cautious the week after this one coming, because I think there's a very good chance we'll see some volatility. But look, volatility is a double-edged sword. Yes, it can impact what you own, but it also creates enormous opportunities if you know what you're looking for. Portfolio analyst this week, it's really just more of what I do every single week, marrying detailed fundamental analysis with sharp timing driven by those two technical setup patterns that I look for. There's no real magic mystery about this. It's just a lot of hard work and a lot of clarity and preparation, and that's what works. In Portfolio Analyst, there are 2 model portfolios, and there are many other trading ideas. So if you haven't tried Portfolio Analyst, it costs you $1 to try it for 2 weeks. You've got access to the full archive that goes back for 3 years. There's an enormous amount of education in that archive, not to speak of the the trading ideas as well. So I think there's an enormous amount of value in Portfolio Analyst for anyone that hasn't tried it. That's it for this week. There's my website, which contains more details on the services, and there's my email address for anyone that wants to communicate with me. That's it for this week. Cheers.